The San Diego market has now changed. Don't list or buy until you see this. Well, I would say the first thing is, what people are getting excited about. And that's good news is finally here, which is great. If anything, and I'm going to talk about it, how it's going to help both the sellers and the buyers and alleviate some of that stoppage pressure that we've received, and where you're going to get some more people that are actually transacting rather than just sitting on the sidelines. I'm taking buyers out. I'm also selling properties. I'm experiencing the bottleneck on both sides. We were hoping for a 0.5 point in a rate decrease. As we all know, I think he's a little bit more cautious. I think he's a little more methodical in his rate decreases. It wasn't expected, in regards to just a quarter. Does that relate exactly into a quarter decrease? No, because rates are really driven from mortgage-backed securities. For that day, actually, we're at a standstill and even increased. I think we're really, really excited about what he said kind of towards the middle to tail end of his speech in regards to continual rate decreases through this year. And I do believe that will alleviate some pressure. First off, I see a lot of my buyers wanting the perfect place. And really what that means to them in my conversations with them is the fact that they don't want to do a lot of work. They're already putting as much as they can down to make sure that that payment is in line with their expectations. So I think that it's something that I wouldn't say they're money strapped, but realistically, they are putting any money towards a down payment to try to get that payment in line with their expectations. Well, the median home price has actually risen slightly this year of a 2.4% increase year to date. Right now we're sitting at $1,075,000 for single family homes. This time last year was about $1,050,000. That's not really a large increase to the years that we've had in the past. The years in the past, we've seen a 10%, 15% increase. For attached homes, we're seeing a median increase almost nominal, to what it's been. We have about 675,000. Last year at this time, it was right at that 675,000. It's really only increased less than $1,000. So really, it's almost at parity of what it was last year.
Talking about this very thing, we were talking about all of kind of what happened from the last Fed meeting to this one, and how things, I wouldn't say necessarily have changed, but I would say what I've kind of talked to my clients about is this Fed meeting really shored up for me anyways. Now, okay, I can see how this is going to now play out. So I have much more concrete things to look at and direction to go versus where everything was a little bit more open-ended over, let's say, last year, but certainly from the last Fed meeting. And what I mean by that is last Fed meeting, we saw some rates start to decline because the market had built in, hey, they're likely going to start to decrease these short-term interest rates. And so that, again, would affect mortgage rates. And great. And so the market started building that in. So over the last month, we've seen mortgage applications for refinance and for purchase business pick up substantially. I mean, it's not an earth-shattering number, but it's moving in the right direction, right? So there's some positivity going on there. And so I would say from end of July, mid-July to literally on Wednesday, rates were trending down. I mean, we got some really good rate market changes. I mean, I locked a few at 5.875 that we did for some 30-year fixed mortgages. So that's better than the 7% where we were at 8 months ago, not even 8 months ago. Trending in the right direction. Problem is now we're doing exactly what I've been telling everybody, and certainly we've discussed this a few times, tend to go and call me right away and say, oh, I see they just dropped it 1/4 or 0.5 point. And so that they think that that's going to translate into their, exactly to their mortgage payment or to their mortgage rate. It doesn't. Those are short-term interest rates. That is a leading it is an indicator for rates to start to trend down on the long end of the curve. The long-term rates are generally, and most times in history, when Fed starts to reduce rates, long-term interest rates start to decline as well. We are not going to have that. I hate to burst everybody's bubble. This is what I've been trying to say. We have too much debt on the books for that to take place. Not that it won't have some hit to bringing down that rate. It's just going to be very minor. It's going to be slow, and it's going to be minor. It's not like it was in the past where they would drop it 1/4 and you would see interest rates long term, the long end of the curve, start to decrease, a 0.5%, let's say, or something to that effect. Because that long-term debt is just insanely big, the bond market, the 10-year treasury isn't willing to budge off of that 4% is now the current threshold. We broke through the 4.2, but we're hovering between 4.2 and 4%. We're just not going to see what everybody was thinking we would see. It's just about being patient. My best advice for everybody is just to be patient. The first step was taken certainly on Wednesday and them doing the rate cut. Now it's going to be a matter of the data really dependent over the next 3 months and over the next 3-4 Fed meetings. But the main issue that caused this thing to kind of take a pause or not give such a rate reduction is also due to the fact that the Fed is saying, hey, there's only going to be one rate cut in 2026. So that doesn't bode well for, hey, we're going to start going into some easing where you would start to see these rates really decline. Everybody just got to be patient. We're headed in the right direction in as far as rates going down. It's just not going to drop down to 4% like everybody's hoping in the next 2 months. My advice is lock it if you have it. If you like the rate, you like the terms and the payments you're in now, I wouldn't wait. It just depends on where you're in contract. But so I'm advising most, if not all, my clients to be patient. Let's see how the next few weeks rolls out. Again, being more data dependent, not to be quoting the Fed, but I'm now very data dependent. So I want to see how this all plays out. And if we clear up tariffs and some other things, this will play into that inflation number as well. So that was another thing that came out today that we might be getting to the tail end of, or getting somewhere closer to the end of that with China, but we'll see. So that's kind of my take on it. My advice now is we're definitely due for an adjustment, let's say from 6% to somewhere between 6 and 5. And so that's a 1-point spread. If you can get into the house, again, this is where you just focus on the house. Forget the rate. This couldn't be more truer than the last, 3-4 years we've been discussing this. This couldn't be more truer because find a house, you're going to end up refinancing in the next 12 months. That's coming. So if you can just get into the house, get in as low as you can as far as the interest rate's concerned for today, and just plan on in the next 6 months that you're going to reduce that rate, somewhere between 6% and 4.99, let's say. So I think that's where we're headed. So again, it's just about finding the right house. In theory, we should start to see more inventory come on the market, but Jerrod would be better to speak to that on whether he thinks, clients would turn to selling their current property that they're in, and taking a 5.5% or even a 5.25%, should that come in the next 6 to 8 months. It'd be kind of interesting to see, because really you're talking about 6 months from now and you're in spring selling season. I think that's where we're going to be. What does that mean? That tells me, all right, okay, if I'm going into the spring selling season, that's going to be, prices are going to increase also just because of the season, but more to the point that the rates will be lower. So you're going to have more competition coming in. Personally, I think if you could find a house in the next 6 months and lock it down, do it. I would absolutely do it. There's not a question in my mind. And let me say, that's probably, I don't know. I was going to say on the listing side of things, I think it's a catch-22. I definitely would start looking at, if you're going to sell your house, you need to sell your house. I would start getting the conversations going for sure on what you need to fix, what you need to have done to get that house ready to list, so that you can just pull the trigger. Because it's going to be, you're going to have a short window of time to land on selling your property and land on purchasing your other one. Things will move quick.
I would say 3 things come to mind right now when you're a buyer in a market like this. And the first thing is the fact that you have potential negotiation room for any concessions. The second thing is potentially you're asking for a lower price and you're more often getting it because there's less competition. And then the third thing, if you have anything that requires a lengthier escrow or anything that is special just to your file, clients, or more importantly, sellers, are going to be more complementary to that. And I think that, if the market does shift, and which very well could, depending upon the Fed's comments in regards to rates coming down, you're going to have mortgage applications that increase. And more importantly, you're going to have more competition out there. So if anything, it bodes well for the seller. And if you're looking at that and if you're out and about, I would say as a buyer, it is much easier to refinance that rate than it is a home amount, because you can't refinance a home amount, you can the rate. So get that home price where you want it to be. I would say that now's the time. We've been in that camp for a couple months now, but now actually is the time where they have alerted the fact that the government is going to do something about that which can basically alleviate some of that monthly payment. Hopefully it will. We're looking at mortgage-backed securities, but by the time you do a second or maybe even third rate cut, mortgage payments are going to come down. Mortgage rates will come down. It's inevitable, and it's happened in the past.
I'm glad you bring up a very huge, good point for any buyers that are trying to come into the market right now, which is sellers are willing to work with you. It's absolutely a buyer's market right now, and that is huge. You can get a lot more than you used to, certainly during COVID times. It's night and day now. So, closing on the last 3 transactions I've got, we had the seller giving concessions. We had the seller come down off their price, or their list price anyways, willing to do all the stuff that you might need when trying to do your purchase. You're getting much more complimentary to your needs from the sellers. So take advantage of it, because that's not common, at least not in San Diego.
And one thing that we're not talking about is the fact that the stock market's up. You have record high stock market. So therefore, your down payment is going to be more right now. Stock market could change. We could get another tariff battle. And if we do, that's going to potentially affect, what you could sell some of your positions at right now. So that is really, really important too, in regards to maybe shifting and kind of mitigating some of that risk in the event that you would have a turn in the stock market. I would say my prediction is the fact that you're going to have somewhat of an equal buying and selling playing field, meaning that you're going to have, I would say, a more compromise when rates go down. And I think that sellers also need to compromise in regards to some of their expectation as far as price. When you look at roughly the 2004 to 2005 numbers, they're parity in a lot of respects, which is good, meaning that values have held. But when you're actually out there in the field, you're looking at some of those agent notes, those private notes, and you're seeing that sellers have offered some concessions. Some of the trending for the past 2 months where you've had prices come down and inventory has increased. My prediction is the fact that you're going to have somewhat of a balanced seller and the buyer. And I think that expectation and more important, hopefully compromise is going to be more uniform than what you're seeing versus it being one-sided or the others in the years past. Sellers are working with you now. Buyers, get off the fence. The Fed has already announced what they're going to do and what they plan to do. And it's only going to help you and alleviate that monthly payment. Sellers, have some compromise. And more importantly, work with some of these buyers. And finding common ground, hopefully buyers and sellers, you can get really what you want.
Don't wait to buy due to rate. Rate's going to take care of itself. Get the house you want. Plan on dropping the payment over the next 12 to 24 months, probably at least 2 times.
A message I would give to any buyers and sellers: allow Dan and I to make a plan for you. A plan with 6 months, 12 months, making sure that we understand and let you know what that monthly payment will look like in maybe 6 to 12 months, knowing that some of these rates may decrease. I think it'd be very helpful. And then that way it can get you into your perfect home and later also get you married to that perfect payment.